Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 13th, 2025. So we got that nudge that I was talking about yesterday. The market's just sitting right on support with the NQs and NASDAQ 100 starting to crack first, and SPY just sitting there. And I said it needed just that little catalyst, that slight little, and it didn't even need a lot, just that little bump. And we got it last night with the Israeli attack on Iran, and that's that. So a little push there. That's the same visual I used in yesterday's video. So the nudge is there, and they're as Pavlov trained his dogs to do by associating the dinner bell with food. The dip buyers do what they do. They buy a dip, and you got to give this market points. It's been resilient, but um, I just saw a comment there, please tell me how to trade this market. Trade off the technicals. Right now, it's simply a breakdown and a back test. This 60-minute candle on SPY is still forming right now. We do have 3 minutes to go, so we're going to close. If it closed right where it is now, we're going to close a hair above the trend line, but not by a wide enough margin. So there's the breakdown. The first half candle, really, it's a 9:30 to 10 p.m. candle. There's the 11 a.m. candle. What did I say, 10:30 p.m., 10 a.m. candle, the 11 a.m. candle, and now we're working on the noon candle right now, which is going to close on around pretty much a back test of the trend line. And that's, again, I look at all these charts collectively. There's ES, the S&P 500 futures, solidly below. The same exact levels I gave you yesterday. To the button, my first target was hit, and that was the first good support level. That's why these are marked that way. And the dip buyers bought exactly where they should have bought on the S&P 500. And again, sometimes I always say this, the reason I watch both, even if I'm only trading one or the other, is there's a whole subset of traders out there, probably roughly equal, that trade the S&P 500 via whether it's SPY or ES, the futures, or any other derivative, and then the whole other subset that like to trade the Nasdaq 100. And so therefore, if one subset comes in and buys, if they buy the SPY at support, they're buying the almost, not exactly, but the top holdings are exactly the same stocks that determine where the Nasdaq 100 goes. Again, the Mag 8, Mag 7. So that's it. So we bounced, and from the futures, we're still comfortably below the trend line after the breakdown and back test. So nothing to really be worried about. And as I made clear this morning, I was very specific to say, when does this breakdown fail? When is it a whipsaw, a false sell signal? When collectively all of these regain their trend lines, not just one. So like I said, SPY, SPY, you have to almost squint to see it close. And within the next minute or so, it's probably going to park on there. And to me, that's just a back test. I always say that, even on a breakdown, if you have to squint to see if it happened, give it the benefit of the doubt. So no, that's there. And on QQQ, remember, QQQ already led the way, breaking down first, waiting for SPY to follow. There's the uptrend line, and it's nice, clean, well-defined off the April 7th lows, or whatever that is, April 6th, I think. That reaction there, a couple more reactions recently, tight, breakdown, back test. Again, not going anywhere, not going down any, in an impulsive manner by any means, but a breakdown is a breakdown, and that's that. So, so the question that was asked, I know it was facetiously today, tell me, how someone know how to trade this market? All you can do is you're either going to trade or not. If you're going to trade, you don't trade off fundamentals or headlines. Nobody does. Nobody does that successfully. Warren Buffett is a fundamental investor. He trades off news or really balance sheets and fundamentals. Traders, if you're swing trading, you need to use technical analysis as your primary, if not only, reasoning for entering and exiting trades. You can second guess snapback rallies and breakdowns and breakouts all day long if you want. You just have to have a style. Stick with it. If your style's not working, figure out what isn't working and what is, and then kind of tweak it. So that's it. All I can tell you is we got the sell signals. Psychology, I took several courses in college. I love it. I think it parlays very well with my skill sets of the market. This is Pavlovian conditioning, aka classical conditioning 101. The bell rings, the dog salivates, whether or not the food's been put out or not, because they've been conditioned when the bell rings, there'll be food. And so that's what the dip buyers do. They do what they've been trained, and especially after a long uptrend, it becomes a very powerful conditioned response after, when you're in these type of markets. So for them not to buy there would have been, whew. But again, we'll see where we go. Let's not overanalyze it. Let's just, look at the facts, and that's a breakdown, and we have those sell signals. And if you want to play the fundamental game or the psychology game, let's play that for one brief second. Okay, so there's only, as most of you know, there's only a small handful of countries on this planet that have nuclear weapons. One of those select elite group, very limited countries, Israel, who has nuclear weapons, just attacked, brazen attack of the only other country that doesn't, that is closest to having nuclear weapons, and that's Iran. So you have a nuclear power attacking a country that was on the verge of nuclear power. But it's all going to be good, right? Because it's kind of like Denmark having a feud with Norway, right? Two peaceful, well-rational, countries of very similar, peoples, if you will, that get along, and they're going to talk it out, right? Obviously, I'm being facetious. We all know the Jews and the Arabs hate each other, and the Arabs want nothing less than the total annihilation of Israel. So, there's going to be retaliation. I think the market's already priced that in. Iran has to and will respond. We all know that. And how they're going to respond yet to be seen. We also know, last night I listened briefly to Netanyahu's speech, and he made sure to really loop Trump in, even though Rubio said, the U.S. has said, oh, we didn't know they were going to attack. We had no hand in this. Netanyahu threw out props to Trump and the U.S. and made sure to kind of loop in and remind everybody that, hey, U.S. has our back. We're their allies. So again, where does it go? This has been on and off for years, since I was a kid, and even before I was a kid, longer than that. They've been just, at each other's throats there in the Middle East. So maybe, ultimately, most likely, in one form or another, it will die down, but not right away. There'll be some more. So where I'm going with this is, let's buy this dip. Let's go long. Let's buy into the weekend. Because remember, today's not Monday or Tuesday where the futures can trade overnight and you can get out quickly. Whoever buys today, whoever is buying this dip right now, or not selling, reducing long exposure if they're too top heavy, has to take it home to the weekend. So where I'm going with this is, again, I am applying mass psychology and saying that despite, again, the reflexive, there's a lot of more day traders, I think, in this market since there have been since 1999. I haven't seen the statistics, but I know that there's those single day options trades are popular now, 1 day option expirations and all that stuff. So you're going to get the dip buyers buy the dip. The $1 million question, who's not going to want to sell and take some profits or lighten up? We know at the end of a prolonged uptrend, most traders along short interest is low. Shorts have given up. You can just see that on this site. You can see in the last week or so, a lot of people capitulating, throwing in the towel on short trades like the Visa that just hit the second price target today, and some of the other, tech stocks. So I'm going to get to the Mag 8 and Mag here in a second. So my point is, I will bet, and that's what I do day in, day out, is technically betting, that we're going to see a sell-off into the close. And we're on sell signals that have not been reversed. Just because they're buying the dip off support, the first pullback to support today in the futures, doesn't mean the breakout's failed. And if it does, and we start regaining those trend lines that I mentioned, then something different's going on. So that's that hard stop. Remember that, we got a week. We're coming up on a weekend here. Crude prices have surged. I covered that. If you watched yesterday's video, besides that little nudge I was looking for, which seems we got, because that's all we needed to get the support break, and it was a pretty good drop in the overnight futures. You have crude now. Look at that, one single day. It was a very timely video yesterday. I covered a lot of points, including that just gentle nudge. We just needed that one catalyst, and there were a lot of things out there right now, I said, going on that it could come from. And also I covered, for the first time in a while, my zones here on crude. And I said, you know, hey, we just entered the yellow zone. Yellow zone, the market doesn't freak out. Orange zone's where it really starts to take note. So let's just look at this. Let's see. Last time we entered the orange zone was right here. I'm going to do that. That was in the beginning of January. Let's take a look there. Well, let's just do it this way. So I'm going to put the crosshairs here. So we had right in the beginning of January, we entered the orange zone back on the 13th, early January. We kissed it right here. That's October. Let me write these down. Early January. I'm doing this on my notepad. Early October. And then this was late June, early July, July. And then this is where I started doing it back here. That was April, and it stayed persistent up to the end of April, so mid to late April. Okay, let's flip it over. Let's look at the tech heavy cues. Let's just turn everything off. And where was the first one I just said? Early January, crude peaked up. What happened? Was there immediate drop? No. But did the market stop going up? Absolutely. It peaked right there. And that coincided with the rise in the iron zone. And we had the biggest drop in years. And that was it. And remember, we were short. And this market started falling long before liquidation day. Liquidation day, I gave you a level. That very day in the regular session, a level that I called it my lights out level. Trump stepped up the podium. That level was hit. And then so the technicals, again, there was a fundamental catalyst, his announcing, you know, the tariffs, with the technical level that would trigger the, you know, next sell signal and impulsive selling that I was looking for. All right, before that, it was early October. That was right here. Didn't do anything. So then it was late June, early July right here. And that's right there. There's July. And we had the biggest drop in years. We milked every penny of that short right down to the 200s. That was my spot on cover morning of August 5th lows. Cover all shorts, go to a full long position, just like back here. And then what was it? March. So you can see right here in mid to late March right there. And that was the biggest drop. So the biggest drops, 1, 2, 3 in years, all coincided with those dips into my orange zone, which again was laid out before that even any of those started happening back here, right? So again, that's it. That's all I can tell you. Now, sometimes you get an orange zone and you push a little higher. In fact, the one that didn't work, you know what? I take that back. So I was 3 for 3. I just told you I wrote down, what was it, early October. We never entered the orange zone there. We stopped at the top of the yellow zone, never punched in. So it's 1, 2, 3, and now 4. And so you can see sometimes you enter it, and quite often you just go a little more. It takes, you know, the masses are slow, if you will. It takes a little while to sink in, and people realize, oh shoot, crude oil's going up. That's going to be inflationary. That's going to further hinder the Fed from cutting rates, and it's also going to stifle economic growth. So we'll see. So it's not an immediate thing, but you can see here it wasn't very long. You get into the orange zone, you didn't stay there very long, and you pulled back down. So this is will most likely, you know, it's happened now, and we could see the market drop next week, or going from this usually within a couple weeks. So the market could still, if it wants to punch out, make marginal new highs. Remember, despite being down today, we're still within what I call spitting distance of new highs. Speaking of which, so are treasuries. Treasuries, again, TLT, the 30-year bond ETF. When it breaks those lows, it means yields will have broken out to new multi-year highs in yields, which would take out key support in TLT, the long bond. And, you know, it hasn't happened yet. And but if it does, like I said, we're just, as I said, just also what I call spitting distance within that. And so here's the 60-minute chart. You know, TLT did have positive divergence on both the daily and 60-minute chart. And it has been moving up. And it may continue. This is a near-term uptrend, so you want to watch for This really, that's I think why I colored that level up, that 84, 87-ish level. I think that will start to call it into question and take us down to new lows if that happens. And it hasn't happened yet. So this is one thing that's supporting the stock market, is the fact that yields kind of went out to the edge of the abyss, stared down at it, but didn't fall into it, right? And so far, meaning new multi-year highs and multi-decade highs in rates. But again, it could. And it's just something to watch for next week. And you can see Treasury bonds going down today, i.e. yields going up. You should normally see the other thing, right? You've got a nuclear power and a near nuclear power at pretty much at war. That's pretty much a declaration of war, if you will, or an act of war. And so normally you'd see institutions moving into treasuries, right? Buying treasuries, causing the prices to go up, yields to go down. It's going the other way. So this market, long bond is not acting as it normally would. And again, one day doesn't make a trend. So just watch it. That's what I've been saying for a while. Watch something to monitor, something to watch, and then something to act on if and when it happens. Okay, there's a lot of sentiment indicators out there. My favorites are really the put to call ratios, particularly the equity only put to call ratio. But this is one well followed, and this is the AAII, which is the American Association of Individual Investors bull bear ratio. In other words, the ratio of those in the weekly survey that are bullish, expecting the market to go up, and those that are bearish. We identified this top with near impunity. By looking at that, as I said, it's typically when you have a period of extended bullishness and everyone starts to get bearish. I recall there was one person on the site saying, "No, Randy, that's actually going to support the market from going up because everyone's getting bearish." I said, "No, on the opposite. After everyone's been bullish for a long time, it's then you cross over right here." After those big hills, I'll call them hills, of bullishness, colored in blue. Then once everyone starts to become bearish, that's when the top is in, and that's what happened here. You had an extended period of bullishness, the stocks were rising, and then the signal came. Now, okay, so that worked. Now, let's just look at the last bear market we had, 2022. This was the first bear market rally right here that I'm boxing in, and you can see what happened is right there as I take the line up. For the first time after everyone got bearish on the first dip, really bearish down to my green buy zone, that's what that is, we had an abatement where we actually flipped briefly, just like right now. So just like then, there's the top, there's the bear market rally so far. There's everybody now getting bullish because stocks have been going up. Again, it's called recency bias, psychology 101. It's most traders in the market associate what's happening and extrapolate going forward. That's going to happen. Just like back here, everybody was bearish when yours truly was getting bullish because everyone else was bearish, and because look at these sentiment, they're down to my green buy zone. This is where the great financial crisis ended, the bear market back then. This is where the last bear market ended. And you got to use it not as a standalone, but just kind of a roadmap. Where are we? Where are the masses at? And the other one I use as well is the CPC. I have different variations of it. I have a daily and a weekly. This is a weekly, meaning the chart up top showing you that's the equity only put to call ratio. This is my green buy zone. This means everyone's fearful. And this is what I call your money where your mouth is indicator versus the AAII, which is what I call the rhetoric indicator, meaning they survey people saying, are you bullish or bearish? Do you expect the market to go up or down in the next whatever period it is? And as I often say, I can be foaming at the mouth bullish, saying, I am so bullish, I think the market's going up, I plan to buy, I'm going to buy, but yet I don't have to buy. Something may change my mind. But when I put my money where my mouth is, I buy a put or a call, whether it's just a directional bet, call betting the market or a stock's going to go up, put being that a stock is going to go down, or I'll buy it as a hedge. Same difference. Maybe I'm long, but I'm not so confident. I don't want to sell my long and have it get stopped out for tax purposes. I don't want to recognize that, so then I'll buy a put against it to kind of limit or protect my downside. So either way, put buying is a bearish bet. and call buying is a bullish bet. So when everybody's buying puts, this goes very high, and then that's time to buy. You want to buy when everyone else is fearful and loading up, buying a lot more puts than calls. You can see all the tags, all these circles here. The biggest drops, if you just went off this indicator, if this was your 401k indicator, you would have blown away the market if you would have waited. And then when you see it hit extremes down low, this is when everybody's getting bullish right here. And now you don't want to, like always say, after a bear market, that's when you want to ignore it for a while, because you've just purged out and had a major shift in the supply demand dynamics. So you want to use it, look for these sell signals after a persistent or an uptrend that's been lasting for a while. Then you start getting these kisses of the red area, and then boom. And then this is what I'm showing you, is that with this whole drop, with the tariffs, which again, long before Trump even came to the podium and even uttered anything about tariffs, the market was already correcting. The technicals told us to be short. And you can see there's just no fear. Where this rally, we can, again, to me, it's still coin toss whether they're going to punch to new highs or not. Maybe today's sell signals get negated. Probably won't know until next week. My thoughts there. But I just wanted to point out that this indicator, and you can see I use these red and green zones, and you can see we got nowhere remotely close to fear on this drop right here. And that, from a contrarian perspective, is bearish. If you got everybody started, loading up, and you saw a lot of fear, like you did down here in the bottom, like you did right there when the financial crisis was ending, like you did in this first drop right here, then you'd say, okay, yeah, it could be over, and we might be going to, starting a new leg up, another 20, 30, 40, 50% upside in the bull market. All right, so that's kind of where we're at. I just want to show you this. And then the other thing I have here, you can see initial tag. It's just a random line. I added this line years ago. I have not updated, tweaked it, touched it, modified it. It's at about just over the 0.6%. It's just a line. It's an EMA. I put a 100-period EMA. Years ago, I played around with different EMAs to see where the big drops came from. And we had one here. I'm off I went all the way back to 2000 and early 08. We hit it right before. This, again, was the financial crisis. One of the biggest and most profitable bear markets to trade in history. One of the most profitable to sidestep if you were long, and it fired there. We had a signal there. And then since then, we've been in clearly a secular bull market with corrections and smaller cyclical bear markets like COVID along the way, right? And you can see when we get down here, so when I put a 100-day moving average, it helps to kind of takes away the noise, if you will. Some of the errant spikes, little reactions to one-off events that happen in the market. It shows the trend of put call buying. Everybody getting bullish, are bearish right there. Everybody getting bearish, and then everybody's starting to get bullish. And then when we hit that level, boom, 21.6% drop. Everybody started getting bearish again, but then they started getting bullish. Hit that level there. We had this sideways. It was 15 months or 18 months of the market going absolutely nowhere. This is the S&P 500, by the way, down below. NASDAQ had bigger drops. There were two drops, about 16, 18%. They were over 20 in the NASDAQ and the S&P, or the small caps. And that was also signaled by everybody losing their fear. Then the next time we hit it here, there was, as there often is, a little bit of a delay, and then we had the next bear market, 28%, roughly ballpark number, drop in the S&P 500, and again, that was triggered there. This, my friends, is the first time we've hit that level, and again, I've had this line for years. It just shows me that the fear has left the building. Everybody's getting emboldened, thinking it doesn't matter what the Fed does, it doesn't matter. AI is here, it's going to change the world. And either way, it's just an indicator I use, and I just want to share that it's now, for the first time since back here, preceding the last bear market, it's come down to that level that I've had there. And please understand, this is the farthest thing in the world from an exact timing indicator. In fact, I just made that very clear. There's quite often a lag time between when the signal hits and when the top is in. It doesn't have to be a lag time. Sometimes it comes pretty quick. I think we hit about right here, actually, more. And the top came right after that. But there can be a lag time. So this would easily support a case for new highs, marginal new high, maybe for the next month or two, followed by then a bigger drop, or not. That's the thing. It's signals there. It's just the range of timing around it can vary. Okay, let's just look at the charts briefly, and we'll wrap this up. To kind of recap everything, we had the minor, our first uptrend line, followed by the secondary one that's set up that gave us the wedge. So this line and the one that just broke the other day gave you first a sell signal in QQQ, pending a sell signal in SPY. That's happened, and that's clearly. You don't have to squint to see it. There's the wedge. There's our sell signal from a couple days. What was that? Wednesday, I think. Yep. And let me change the color here. We'll go yes one right. Sell signal right there, and we're moving lower. So nothing's changed there. PPO has probably made a bearish crossover. I'd have to put up the histogram to see. SPY, the S&P 500. As you can see on the daily chart, now clearly below, and I also showed you the 60-minute earlier to kind of get a little more precise. That's what the 60 minutes good for. Divergent high there. As would be any new high soon, you can extend the divergence a little bit. But again, if it's much more than a slight, meaning ever so slightly equal or marginal new high, it'll take out these divergences. But again, I at this point, now that we have the sell signals, remember I say how the odds bet, just like if you've ever bet the horses, you watch the boards up right until the betting closes, right before the race starts. The odds are changing in real time as the bets are coming in. And so the odds on the market, now that we've broken down, I think it increases the odds. We're not going to go to new highs like the entire world, at least the media and everyone I talk to, has literally pretty much baked it into the cake that the market's going to go to new highs. Again, it's semantics, really, guys. It honestly is. If we go to touch those highs, kiss them, or just pop them, and then reverse, you're only talking. It's especially relative to my long-term downside targets, calling for a drop of 50% or more on the Nasdaq 100 and close to that on the S&P 500 from my long-term targets. What's another 1-2%, right? 3%, 4%. It's relative to the downside potential. But I'm here to just tell you and reiterate, and it goes back to that post. How do you trade this market? You either believe in the technicals. You don't have to believe in my interpretation of them or not. I provide you my thoughts. I provide you what I see. Take it with your own. Take it with that of others. I can just tell you that those sell signals are intact. We're moving lower. And, Pavlov's dogs bought the dip today because they've been doing that for weeks now. Most of them weren't doing it here. They wanted to sell. This is, where the JCL longs come in, what I call them, Johnny come lately. They wanted to sell here, but they want to buy now, and they think the market's going to go up forever, just like they thought it was going to drop forever here, because they thought for some reason that we'd have 200% tariffs on China for an extended period of time, and yet the world wouldn't come to a screeching halt if the two biggest economies in the world, who are completely interdependent on each other, just stop trading with each other. It's absurd. So, anywho, then the other one are the smallies. There's the mid caps in between. MDY. If anybody trades them, let me know. But I just kind of jumped to the other end of the spectrum and like to trade the small caps. So on the small caps, this is IWM, the Russell 2000. Divergent high one, big drop, double digit drop. The divergences got larger. That's this line here is your divergence line. Give me my line tool. Divergent high one right there. Actually, we had a first divergent high here. It's a series of divergences. Double digit drop. The divergence got even bigger to this point. Even bigger drop, bigger divergence. Not always, but often equals a bigger drop. And then that divergence continued up. In other words, the index prices were making higher highs, but the indicators continued to make lower highs. It's the same divergence. Finally, the bigger the divergence, typically the bigger the drop, and it resulted in a 30% drop in the small caps. We had what I still consider in the smallies a bear market rally, and everything pretty much. And right back, turn off all the lines to those beautiful 200-day moving averages that just do such a phenomenal job in a bull market of defining a trend by pullbacks to the 200s once the 200s are taken out. Now, given the large caps have exceeded the 200s, not unusual. In fact, it's more than common to see, punches through in a bull market that are brief. I don't have any right here on IWM, but all I can tell you is we rallied right back to the 200 simple. That's the blue line there, simple moving average, and a perfect rejection off it so far. Put back the lines. We also have one of my favorites, a bearish rising wedge pattern, as I mentioned. This is the negative divergence. First divergence on the daily chart since right here. We all know what happened then. So, and yeah, it's much smaller wedge, smaller divergence. But big if, guys, big if I'm right, and this is a bear market rally, that's all you get in bear markets. You don't get these. And the primary trend. You get a big divergent low, not even that big actually. Bear markets end with smaller divergences than the tops do in bull markets. Typically, that's my experience, but we'll see what happens. Either way, that's about all you can ask for. Overbought, negative divergence in a bear market. So, and then you have the uptrend line right here that forms as I'm drawing out. This is a textbook bearish rising wedge pattern. And today, a breakdown. That breakdown happened to take us to support, which so far they bought at the lows. You don't see it on a daily chart that much. You have to go to a shorter term chart like the 60-minute, or even here, draw this like this. I have a chart on the futures I'm going to show you. But there's that uptrend line. And that's a breakdown and a back test. Let me tighten it up a little bit there. Yeah, right about there. It's good. Either way. So that's what it looks like on the 60-minute chart. Also divergence, like this 60-minute time frame for swing trading, negative divergence. And you have a primary downtrend line here. I want to show you RTY as well because we're back testing. RTY are the futures for the Russell 2000. The charts are going to look a little different sometimes than the actual index itself or the ETF. There's our primary downtrend line. This is the wedge that I was just showing you on IWM. And there's the breakdown today. We kissed perfectly at the lows, a back test. So there's something for everybody here, for the bulls. And I mean this, I'm not trying to be sarcastic or anything. If you are bullish and think the markets, you like the small caps, this is what you should have bought with both fists. That's the first back test since the breakout right here, breakout back test. So if this market's going to go to new highs, bulls should step in, as they did already. They gobbled that up at the lows, reverse, and go on to take these resistance levels out. I gave you recently highlighted IWM as a short trade with either a tight stop above this resistance level or a more liberal stop here if you're going for the longer term targets, bear market targets. So that still would be, if we're going to go up, that's your next resistance level. Very good one at that. That's 22, 24, 50-ish. We'll call it 22.25 on the small cap futures RTY. However, here's a bearish rising wedge. Here's a breakdown right here, and we're still below it. Coming back in, we're still below there. The measured target of a bearish rising wedge, I really need to take that top line. It's hard on this software. I'm going to move this so I can grab it. There it is. There's the grab. There's the top of the wedge. And in technical analysis, I find the simplest formulas. You'll see different ones on different websites. Take the widest part of the wedge, add that to where it breaks down, and that gives you a measured target for the wedge. That would take us somewhere down around there, just ballparking it, just eyeballing it. All right, let's just wrap this video up with just going through the top 10 or so holdings in the NASDAQ 100, which are also, most of those are also the top holdings in the S&P 500. And as I often say, an index or a sector is simply a sum of its parts, but more accurately speaking, an index such as the S&P 500 or NASDAQ 100, which are cap-weighted index, are a cap-weighted sum of its parts. In other words, you want to look at the equal weighted indexes like QQQE or RSP. They track the Nasdaq 100 and the S&P 500 in an equal weighted measure. They are simply a sum of its parts. In this case, they're not. And you don't trade. They don't have futures that I know of for the equal weighted. So if you're going to trade the futures, you're going to just, all that matters is where these mega caps go, because they have a tremendous outsized weighting on the index performance. So this is Microsoft. The best I can give you right here is this. It's not a super clear chart. It's a nice clean uptrend line. It'll show better. I'm on a daily. That trend line will show a lot cleaner on a 60-minute chart. You do have divergence forming with lower lows on the indicators, and you're really pretty much, this one's just punched out its previous high there. When I look at the weekly chart, nothing's changed. This is massive divergence. This to me looks like just a major top in play here, with the big multi-month, even almost multi-year negative divergence there on Microsoft. But let's go back. Let's stick to the daily charts now. I can go all these weekly charts. I've covered them many times. They'll have divergence. NVIDIA most recently highlighted as a short entry here, and a couple times since. We had shorted it right there on that back test of the deep steep gap, or right immediately following it when it broke down the trend line as well. Monster short. I covered all shorts here, and they're leading up to and right off those lows there, including NVIDIA. And it also hit, well, these are the new targets that I gave you on this most recent trade. So right here, we're exactly where we were. And again, I have a lot of sayings I make up, my own little yogiisms, I call them, if you will, in trading. And one of those is, patience. And most people don't have it. I know that. Most people, in investing, you most certainly have to have patience. I mean, Warren Buffett was famous for that. He'd, sit with a company and add down if he believed in it for years. And then ultimately, more often than not, they paid off. Swing trading is the same thing. A lot of times, I think people get spoiled with, because a lot of the setups I have, I'm very precise with my entries, exits, and price targets and entry points, and sometimes we nail tops, bottoms, almost with precision, and exits on, on a trade when it hits a price target, then reverses. There's other times where you got to give it a little patience. And again, as long as you stick with your trading plan. If you're targeting, I gave you these kind of what I call swing targets. They're aggressive to most, and I have even longer term targets on the weekly chart. But if you're going for T6, your stop can be way up here. If you're only going for T1, 2, or 3, you're going to have a little tighter stop relative, using a good risk reward ratio. 3 to 1, at least 2 to 1. It all depends on the trade and your preference. Some might use a 4 to 1 RR. But this is it. We're exactly right now, today, where we were when I highlighted this as an objective short here and again here, and that's it. And not only that, nothing's changed. We had negative divergence when we first hit this key 142.50-ish level, which is, again, the deep seek gap right here, that massive gap. Very technically significant, because when we got there and backfilled the gap, we had one of the biggest drops in NVIDIA in years, and there's no way to say we can't punch it through. And if we do, then that's what stops are for. That's it. Move on to the next one. It's not a big deal. Don't put all your eggs in one basket. You shouldn't have half your account or your entire account in this one trade. But I just want to say the only thing that's changed since, we're still there. We made a slightly, we simply extended the negative divergence from where it was back here, and we're right back to where we were. In fact, if I want to say the only other thing that happened, we had a failed breakout. It's not really, let me be more specific. We have the potential to have it be a failed breakout. We tried to get above 142.50, the top of that gap right there, and there's the gap. We're back on it right now. It'll fail. When it clearly fails, that's going to be pretty bullish. When you see whether it's a single day red candle or a couple days, the further you get away from it, again, it's an incremental, not an absolute binary thing. Oh my God, above 142.50 outright bullish and below 142.50 outright bearish. No, it is an incremental thing. Every tick you get lower, especially now that you've taken it out, you most likely see the selling begin to accelerate as more and more longs get stopped out. The Johnny-come-latelys that didn't want to buy NVIDIA here when we were buying and covering that short, they wanted to buy it here or even here lately. You can even go to a volume at price histogram bar and it'll show you there's been a lot of trades here. Everybody chasing the rally. It's timeless. It's as old as the markets, in the modern form. You get a lot of, especially the retail crowd coming in and chasing it as the institutions start to pass the baton, if you will. All right, so that's it. Let's not talk much more on it. Still an objective short because we're still at that level. Patience pays, and nothing's 100%, and that's what stops are for. You determine your stop, assuming you even agree with me. If you're bullish, then the same level I'm looking to see a failure, you want to see us get away from there, and each tick higher, especially if and when these divergences are taken out, is going to support the case that NVIDIA is going to go on and take new highs. As of now, I called a top in it here with a bearish engulfing candle. We shorted back then, and that is the top so far, that bearish engulfing candle back from January 7th. So just like the stock market, and it's no coincidence because this is now the it's been leapfrogging Microsoft with being the biggest component or not, and so the Nasdaq 100 is going to mirror NVIDIA, Microsoft. That's why I'm going over these for you. Now, something's going on with Apple. Apple, forever in a year, I mean, for the past decade or more, has consistently, once in a while, in recent years, it's been leapfrogging with Microsoft. But for years, it was the largest and most profitable and the strongest stock and the largest component of the Nasdaq 100 and S&P 500, and it's fallen back quite a bit. It's still clinging by the skin of its teeth to the $3 trillion club right now. How I know that? You can go right here. My watch list I have always sorted by market cap. Microsoft 3.5 trillion, NVIDIA 3.5, Apple 3 trillion. It goes much lower. Not a huge deal. But what is a huge deal to me, and again, it's been priced into the technicals forever and a day, especially when I go to the long-term weekly and even monthly charts. One's not. There it is. There's my annotations. Apple broke the secular bull market uptrend line. Comes off 03, not 07, 03. That's the secular bull market uptrend line for Apple. And it's now clearly below it. And it's flirting with, it's actually also taken out now that 20-month exponential moving average I like to use as a trend indicator. So, and again, when you look at the daily chart, what's wrong? What's wrong with Apple, which is still down 25%? Again, you want to see more of the market leaders doing this, and just to safely say that the bull market's over. One of them, sometimes Apple, or any one of them can have a reset, kind of go against the crowd, but it's worth noting. Oh, and technically, here's a downtrend line that it's been struggling with lately, and a little uptrend line that just got taken out. Big support right here. This is big support. Remember, we had these targets back here off the highs, 1, 2, 3, 4. This would have been my next target. It's good support, 193.46. We'll call it 193. An important level, I think, for Apple if you want to set a price alert there. Amazon, again, this is number 4 in the Nasdaq 100. Beautiful little bearish rising wedge. Breakdown yesterday. Managed to recoup some of the losses, but still printed a close below there and below it again today. So positive at the moment, but doesn't matter. It's below the bearish rising wedge pattern. It's on a sell signal, in my opinion, just like it was here. And, back then, nobody wanted to believe it. And they were buying, and it gets incremental. And then the further you get away, the dip buyers start to realize, sometimes they can be a very slow crowd to realize, but it's what I call the point of recognition, where they realize, rut-row, like the Scooby-Doo rut-row, something's wrong. I keep buying the dip. It was working so well for so long, and then boom, right? So we're not there yet, but with each tick lower, and you take out support levels like 206.50 right there. You take out the 200 days. That's my lights out number for the market. I've been telling you guys, when the indexes and the majority of these mag 7 or 8 or 9, 10 stocks fall back below the 200s. In my opinion, you will see selling begin to accelerate rapidly, meaning you wait a week, you're going to miss out most of the move, in my opinion. Alrighty, Alphabet. Again, just such a major stock psychologically and weighting in the indexes as well. There's your primary trend line off the, not my, this is on the daily chart. Primary trend line off the October 22 lows, kissed it perfectly right there. Lots of nice clean reactions. And then major price support. That is a lights out level right there. That's my O. Lights out when that's taken out. Now, we got a ways to go. Right now, we're kind of just as likely to go and take out new highs. We're about equidistance to new highs, or testing the old highs, or taking that level out. What I can tell you definitively is that I have right now this uptrend line right here. You have almost divergence. You have about equal highs in the PPO, slightly higher high in the RSI, but there's an uptrend line to watch, and then price support. And then again, this is the primary uptrend line that was taken out right here. And so maybe it wants to go up a little more. That would help support the market breaking out to new highs, a little more upside in Alphabet due to its weighting, and then a rejection. That's a very likely or possible scenario, probable I should say. Meta wedging up. Again, a lot of it's odd. A lot of the market leaders have peaked. NVIDIA, this is again, I'm talking about, it's an AI bubble. NVIDIA is now up there, the top component, and along with Microsoft, and they're both big AI, all in on AI. Microsoft with and Copilot and all their other AI stuff. There's the rising wedge on Meta, and that one just broke too. So what I'm doing is one by one, tick by tick. You're looking for either check marks that have either occurred or we're waiting to see check marks. That is a check mark there. It broke down yesterday, and it's following through today. Not by a lot, but we're heading into a weekend. And if I know how the market likes to work, it likes to trap. See this, when the bottom was in, nobody wanted to buy, very few. We were buying there and covering shorts and going long, actually here. But see, when Meta put in that divergent low, then a big gap, it likes to do this when trend reversals in a bear market or even a strong bull market. It likes to do these gaps, and it denies objective entries for longs, and it helps to trap short sellers in by bypassing their stop loss orders. So we'll see what happens next week. Again, a lot can and probably will happen over the weekend with what's going on in the Middle East. Plus, it's not just that. There's so much right now. Trump and China and all that good stuff, and the big bloated bill. I don't know. We haven't heard much because they have till I think July to try to get that pushed through the Senate. Broadcom, this is an active trade. Breakdown there. We're about where we entered it right now, so no change. So no reason to update. We hit that support. Oh, I added this today, guys. That's why I put that 613.25 to remind me when I covered it next to tell you. I added a support level here about 238.78, which is where we hit the other day. Now I see enough reaction there, and these reactions right there, and that big old gap. So that's a support level. It's not. I'm keeping my targets as is. But we need, once we break that support level about a little above 239, that should open the door for a move down to T1 and ultimately these other targets right there. And again, you either take it or you don't take it. You're gonna have to have patience if you're holding out for the prize. The prize is a total drop of about 65% or so, and I can all but guarantee you this is one of the largest, not only one of the largest semis, it is also one of the top components. This is a MAG8. When I extend it, you can see here again the weightings of the NASDAQ 100. Microsoft number one, NVIDIA number, well, these are tied at 3.5 trillion. Apple, Amazon, Alphabet, Meta, Broadcom, Tesla, and Netflix. So I'm going to go to those and maybe a little more. I want to maybe talk about Costco and we'll wrap it up. Tesla doing what it's doing, coming off that divergent low, after that divergent high, swing, bounce, swing, little, and then we had that little, just like the indexes and so many stocks do now that I just highlighted, nice, clean, bearish rising wedge. It broke down here, dropped down. Now we set up this secondary trend line, which I added recently because we had a third and confirming reaction there. And I don't have much of an opinion on Tesla right now, to be honest with you, near-term direction. Netflix, big divergent high, just continues to build. Once the recession clearly gets underway, watch the jobs numbers. We'll see what I'm gonna call hashtag cancel culture or whatever. Not that what they did back a couple years ago when celebrities were getting canceled if they weren't woke or politically correct. I'm talking. I think the big theme going forward later this year and in 2026 and beyond will be cancel your streaming service. Everybody's got Netflix and Apple TV and Amazon Prime and Paramount Plus and HBO Max, and there's some great shows. I'm one of them, but it's getting ridiculous now. And when people's budgets start to get hit, they're going to cancel. And I think Netflix is going to really feel the pain on that. And so, making these divergent highs, and sooner or later, as the divergence continues to build, that's what it looks like on the weekly chart. Big divergence building, and it's going to minimum come back and visit this trend line in the 200 days. It's even in the healthiest of bull markets. That's what it does. Comes back right like I'm circling here to the trend line in the 200 days, like it did there, like it did here. And to get there, now $1 million question when, but it's going to be about a 20% drop. And then ultimately, no trend lasts forever. Just like this one here. We had a big bull market. It goes way back. And just like, divergent high. And it keeps checking the trend lines in the 200s. And finally, one day it breaks. And then you have a real bear market. And that was a 77% drop off the divergent high. And I think nothing less. I think this is ripe for a breakdown, and I think it will take this stock down probably minimum 50% right there. Well, minimum target on the weekly I have after the trend line's broken right there. All right, we're almost done. Costco. Let's talk Costco because some writer and I think Barron just figured he'd try to throw out and come up with a new acronym, and it was called CAL. He said, forget about FANG or MAG 8 or whatever it was, MAG 7. The cows are where you want to put your money now. And that was going from memory here, so bear with me. Costco, O'Reilly Automotive, and Walmart. Yeah. So, and I just laugh. I'm like, okay, you want to try to come up with some cool acronym because it flows well. Sounds boring, but that's what these are, retail stocks. Here's my take on Costco. This was the uptrend line right here off the 2023 lows. It's been building big divergence. We already broke down, hit the 200s and bounced and backtest. We're backtesting the trend line from below. So this one's on a sell signal coming down at minimum to right here. Then ultimately, these are my bear market targets. Every annotated level up to this trend line right here in 610. So I'm calling from a drop from the recent highs of about 42% in Costco over the next year or two. On the daily chart right there, you can see the same. I zoom in. Here's the uptrend line, near-term uptrend line, breakdown, hit the 200s. They bought it as they always will on a pullback to the. Oh, they always will until they don't, and then something different's happening, and so far rejected. So and that's following a big divergent high. So again, Costco looks to be headed lower. I don't think that cow trade is going to work out so well this year. That's just my opinion. The other one was O'Reilly. Over RLY, I believe it is. Yeah. There's my daily chart on O'Reilly. It's walking the line right now, just like Johnny Cash. This is uptrend line off the 2020 low, and the 200-day moving averages, which on so many stocks are just beautiful support levels. Correction mode, you're below them, or bear market, and secular in a bull market, you want to buy pullbacks to them. It would have served you very well on O'Reilly. But the thing is, you have to recognize, again, you have corrections. It's not unusual, just like the stock markets, to briefly come under the 200s in a primary trend, only to see, recovery. And if you bought every pullback to the 200s there, or got out when you were below and then re-entered when you took it back, you've done very well, right? All I can tell you definitively, we had that beautiful uptrend line in the 200s just below, and this little price support around 87. So 87, if you want to set a price alert there, and then I'd also set alert under the 200-day moving averages, and that will most likely end this cyclical larger bull market and bring O'Reilly down quite a bit. So anyway, you can jump on that cow trade now. This to me looks like a train that's long long since left the station. It's not to say this thing can't go up. It's in a bull trend. There's no one that can argue that. I just think the upside appears limited, and I think it's ridiculous to kind of throw that out there now like you're starting a new thing. You know, put your money in the cows. It's crazy. And then Walmart, WMT, world's largest retailer. Divergent high, bearish rising wedge, breakdown, sell signal, secondary trend line taken out, hit the 200s, bought it like they should have and did. Also price support right there, but we set up just like the stock market. It's put in so far. It's a lower high at another rising wedge pattern with negative divergence. Look, you had a divergent low there. This is swing trading right here, guys. Divergent high. Sell signal followed that, breakdown, short it down there, buy the 200s, buy the bullish falling wedge or the positive divergence and the pullback to support, rally up, sell it here on this recent breakdown below the bearish rising wedge. At this point, it already broke down. You already kissed, again, I've had that line here, 99.10, created this line. Let me see so you can see pop-up box on February 19th, 2024, 93.10. We hit that level yesterday. We had a low of 93.43, close enough. Again, I would say cover a little bit above the actual support level. I'm not in this one, but I'm just showing it out to you. I'm sharing it to let you know that I don't agree with the cow trade thing. In fact, I think these, and again, it's all has to do. Think about it. These are retailers, and the Fed hasn't allowed a recession. It's that analogy I've used before, prescribed burns, a forestry service, whether you're out in California or even here in Florida, we do them as well, where the forestry department will go in and periodically burn down the scrub, the undergrowth, to prevent a major fire that's going to take down the 100-year oaks and all, because that acts as tinder or fuel for the fires. And the same thing happens in economics. If you don't allow a recession, and the Fed, every time the markets hiccup the economy, they've rushed to the rescue with quantitative easing and zero interest rates. And that works until it doesn't work, or they can't do it anymore. And I just talked to you today, or showed you in the beginning of the video, with what's happening now with crude prices, and that's going to further handcuff them. So either way, it is, charts are what they are, and I give you the levels to watch, and so watch Walmart, watch all these levels, and again, it's also a tell on the consumer, just like those credit card trades I gave you. Visa, which hit the second target, I already got that out to you today. MasterCard, I also gave you targets there. I didn't list that as an official, but I told you also the same wedge breakdown. MasterCard breaking down after the divergent high, and American Express, I made that one an official trade, and it's coming up on our first target there, the wedge break. And this looks just like the stock market, the bigger divergent high, the drop down, the powerful rally that everyone thinks is going to take to new highs, and maybe will or not again. But the difference is some of these are breaking down already. And these are the key stocks, tell on the consumer in the economy. And so you can see these guys breaking down, and if and as these continue onto my targets, very unlikely you're going to see American Express doing this and the stock market going up. That AI bubble is going to go until people stop buying it. And then when the trade reverses, it's going to be very powerful. And as much or more money will be made on the way down shorting those stocks once the trend is clearly turned, once the key levels are broken. And like I said, until now, we'll see where this day ends. We'll see where next week goes. I'm going to wrap the video here. A lot can happen over the weekend or not, but we know that one way or another, this isn't over. I'm talking about the Israeli strikes on Iran. We'll see to what extent it escalates or de-escalates, and I still think we'll get an end-of-day dump in the market as traders start to hedge up their bets. And to either reduce some long holdings or start buying some put protection. And as I told you the other day, the VIX is on sale. As I told you back here, the VIX is looking cheap again. And I gave you this level. It's where a couple weeks ago, so we either break out or come a little lower to 16.15, hit it to the button, and then we popped that bearish rising wedge right there, or I'm sorry, bullish falling wedge. There's the breakout in the VIX. So you have the VIX breaking out along with the stock market breaking down. It doesn't get any better than that for me. I don't care how resilient this trend is. I don't care that they bought the dip today. They want to prove me wrong next week and undo those sell signals, so be it. And then I'll have to react and position accordingly. Otherwise, I'm going home short. Pretty good short too for the weekend. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.